Are we starting to see cracks in the US Treasury as the ultimate safe haven asset? The recent Iranian crisis can give us some insight. When a geopolitical crisis hits, like the escalation we saw in Iran, one thing usually happens like clockwork. Investors rush into US Treasury bonds. They're considered the ultimate safe haven. But this time, that stampede didn't happen, and that's raising serious questions about what's going on under the surface of the global economy. Let's start with the context. Over the past few weeks, tensions between the United States and Iran had surged. Drone strikes, retaliatory missile launches, constant threats, warnings from both sides about escalation. Oil prices jumped, and the headlines were screaming about the risk of a broader Middle East war. In past crises, from Iraq to Syria to Ukraine, the immediate financial reaction would have often been a rush into U.S. Treasuries. Why? Because in moments of fear, big investors want safety. And for decades, U.S. Treasury bonds have been the definition of safe, with former Fed Chair Alan Greenspan once noting the United States can pay any debt it has because we can always print money to do that. But here's the problem. This time, the move into Treasuries was muted. Yields on long-term bonds didn't drop like we'd expect. In fact, in some cases, it even edged higher. It's not the reaction you'd expect during a geopolitical flare-up. Normally, a crisis of this scale would push yields down as prices rise, but that did not happen. Notwithstanding a very brief move higher following the U.S. attack, but even that was short-lived and overtaken by other economic events. And this wasn't just a blip. This may have been an early warning sign that something fundamental has changed. So why didn't investors pile into U.S. Treasuries? First of all, who are these investors? Who have been traditionally the big buyers of these treasuries in the first place? The first group, foreign central banks like China, Japan, Saudi Arabia. The second group, U.S. institutions, pension funds, banks, insurers. And third, retail and institutional investors, everyone from Ray Dalio to your uncle's 401k. But lately, every single one of these groups have been having second thoughts about piling into U.S. debt. Let's start with foreign central banks. China has been gradually reducing its U.S. bond holdings, not dumping them overnight, but definitely trimming the amount of U.S. debt they hold on their books. And as to why? Because holding U.S. debt exposes China to geopolitical leverage. The more reliant they are on U.S. bonds, the more exposed they are to U.S. financial power. And it's not just China. Japan, the largest holder of U.S. Treasuries, has sold off nearly $250 billion worth of debt over the past 2 years, partly to defend the yen, partly because they need the cash at home. Meanwhile, oil-rich Gulf states, those who used to recycle petrodollars, lending out the money they earned from selling their oil, lending that money back to the United States by buying treasuries, are spending more domestically and seeking diversification into Chinese infrastructure, into African ports, even into gold. So, with these traditional buyers of U.S. Treasuries stepping back, what about U.S. institutions? Shouldn't they be buying up U.S. debt? Well, not so fast. Banks are under pressure. Rising interest rates over the last 2 years crushed their bond portfolios, leading to collapses like Silicon Valley Bank. And insurers and pensioners, well, they're looking for yield and very wary of long-term government exposure in a high-debt, inflation-prone world. As such, even domestic buyers, those pension funds, those banks, those insurers, are no longer automatic Treasury fans. And here's the problem. Despite weak demand, despite traditional buyers of U.S. debt stepping back, the U.S. government still has to borrow, and a lot. Over $2 trillion is expected to be borrowed this year alone, and the CBO, the Congressional Budget Office, expects annual deficits north of $2 trillion into the 2030s. And remember, when demand is low but supply is high, bond prices fall and yields rise. That pushes up borrowing costs on everything from mortgages to business loans to student debt. So, in a strange twist, even a geopolitical crisis, normally a reason for yields to fall, can't offset the market's growing skepticism. And there's real consequences to U.S. Treasuries not being as attractive as they once were. Rising bond yields mean the U.S. government has to pay more to borrow. In 2020, the interest on U.S. debt was around $300 billion per year. By 2024, that had reached over $1 trillion. Interest payments now exceed military spending, and with every new Treasury auction, investors are asking, is this sustainable? And if bond yields keep rising, the Fed is somewhat cornered. Cut interest rates to ease the pressure and risk reigniting inflation. Keep rates high and risk a debt spiral. Neither outcome is pretty. So, what are the longer-term economic implications of a world where no one wants to pile into U.S. Treasuries, even during a crisis? 1. Less room to maneuver. The U.S. can't spend freely during crises if its borrowing costs surge. 2. Higher baseline interest rates. For consumers and businesses, interest rates may stay higher for longer. 3. A greater risk of market instability. If Treasury auctions begin to fail or sputter, it could trigger a panic. Not in Iran, but in financial markets. And 4th, the weakening of the dollar's dominance. If fewer countries hold treasuries, the dollar's global role slowly erodes. So what does this all mean? Are we talking about a shifting financial order? Well, this isn't just about Iran. It's about what happens when the global financial system starts to doubt the reliability of the U.S. bond market, even in moments of fear. We're seeing slow movements toward alternative systems, BRICS countries building their own payment networks, central banks buying gold, and more transactions settled in yuan. None of these threaten U.S. Treasuries today, but in the aggregate, they show a world that's no longer blindly loyal to U.S. debt. The U.S. Treasury market is still the biggest, deepest bond market in the world, but it's not invincible. And the lack of a strong rally during the Iran crisis is definitely a warning sign to which investors and everyday citizens need to take heed. In a world of $37 trillion debt, declining foreign demand, and rising geopolitical risk, the real safe haven might not be the one we've always counted on. And the next crisis, whether it starts in Tehran, Taipei, or Texas, might not send money flooding into treasuries. It might send investors asking, what comes after the U.S. bond market? If you found this breakdown helpful, make sure you hit that like button, subscribe, and drop your thoughts in the comments below. Where do you think the next big bond crisis will start, from abroad or in the United States? Thanks for watching, and see you next time.